Let's start with clarifying this. What is a recession? A recession is when you see 2 quarters of economic growth. So economic growth is measured through something called GDP, which stands for gross domestic product. A recession by definition is when you have 2 quarters, which is 6 months of economic decline. Now, what causes an economic decline? Well, it's when you have slower spending. Because if you have $100 in your pocket and you go to a restaurant and you spend that $100, but now this restaurant has more money that they can use to go and hire more employees, buy more products, go open another restaurant store. So when you spend more money, somebody else makes more money, which helps the economy grow. But when the prices of things go up significantly, or if people don't have money to spend, well, now you go to the store and you don't buy anything. So if you don't go to the restaurant and spend $100, well, now they don't have money to go out and invest in more people. They don't have money to go out and open up a new restaurant. They don't have money to go out and buy more products because people aren't spending as much money. So when spending goes down, that causes the economy to slow down, and that's what a recession is if you see that happen for 6 consecutive months. So our economy right now is slowing down, and if we see another quarter of slowdown, that means that we are in a recession. But if our economy can pick back up, then we're not in a recession technically yet. And the way that we're paying the price is through inflation. So now if you want to go buy your groceries, you want to go on a vacation, you want to go and do anything, it's going to cost you more money because the value of our dollars have dropped. So we've been seeing a record high amount of inflation, and now to combat inflation, the Federal Reserve Bank is working to ramp up interest rates because it's a way to do the opposite of what we did in 2020 and 2021. In 2020 and 2021, it was a loose monetary policy of a whole lot of stimulus, putting money into the economy, cutting interest rates. Now, the Fed is doing the opposite. They're raising interest rates, it's making it more expensive to borrow money, and they're doing quantitative tightening. They are reducing their balance sheet, they're selling off assets, which means that they don't want to have as many dollars in our economy. So these 2 factors working together is what everybody's paying attention to see whether or not we're going to have a recession. Inflation has been hovering at around 8 to 9%, which means that if your income or your wealth has not grown by 8 to 9% from 1 year ago, that means you're poorer today than you were 1 year ago. This is the problem with inflation, is that it disproportionately affects the middle class and the poor negatively versus the wealthy. Because the middle class and the poor are the people that pay the price through inflation, while wealthy, the people who own the assets, benefit. Remember, a recession is caused by slowdown in the economy, and a slowdown in the economy is measured by slowdown in spending. So if the price of everything goes up and the amount of income that you have, the money that you have, hasn't increased that much, that means you just have less money that you can spend. So if you have less money to go out and buy stuff in the economy with, that means there's going to be less spending happening in the economy. You just don't have enough dollars to go out and spend the way that you could before, so you shrink your lifestyle, which means less spending, which means a slowdown in the economy. So that's what we're seeing happen on the consumer level, and now it's becoming a bigger issue on the business side as well. I was just talking to a buddy of mine who is a pretty high up executive official in one of the bigger automotive companies, and what he was telling me is that inflation is really hurting their company's profits, that they're bleeding money right now, and the reason why they're bleeding money is because of inflation, that they've been trying to eat up these higher costs, but they can't keep doing that anymore, and now they're also facing a pricing power issue because they don't have the ability to keep raising the price of their products because consumers can't keep affording their products, and so they're facing a really tough issue. Because on one hand, you have CPI, which is the inflation that consumers feel, and then on the business side, there's something called PPI. Well, CPI has been between 8 and 9%, but the PPI, which is the inflation that business owners feel, is somewhere between 11 to 12%, which means this higher cost that businesses have to produce products is much higher than what the inflation that consumers are facing. And so businesses are facing a tougher and tougher dilemma now, because if you don't have the ability to keep raising the price of your products because people can't afford your stuff, even though your cost is going up, it's going to hit your profits. And if your company isn't structured in a way to be able to absorb this higher cost, well, that's going to be a bigger problem. And that's what the buddy of mine was saying. Now, in case you were wondering, he does not work for a public company, so you cannot trade this information because it's not insider information. Sorry. This is where you have to pay attention to how interest rates are going to affect businesses and investment in businesses, because we're going to see a big change in that. For the last number of years, and especially the last 2 years, we've seen a massive boom of venture capital investing into startups. And the reason why venture capital companies have been able to invest so much money into startups is through the help of cheap debt. Because if you are an investing institution, if you are a venture capital company and you can borrow hundreds of millions of dollars at 3 or 4% a year, you don't need that big of a return in order to justify your investment. So you are making millions and millions and millions of dollars of investments into companies which may or may not work, and you were just throwing your money around because, well, the money was cheap. So it was very easy to find funding for these startups, and you had no real incentive to produce a profit if you were one of these startups because, well, why would you want to produce a profit when you could just continue to borrow money and continue to leverage up your operations and try to go bigger and bigger and bigger? But now the interest rates are getting higher quickly because we just saw that the Fed raised interest rates again. That means it's going to get even more expensive to borrow money. Well, now that it's becoming more and more expensive to borrow money, and it looks like it's going to get even more expensive because the Fed wants to hike interest rates even more and even more aggressively, well, that means that you are not going to see that same type of investment that we did before. Because before, if you could borrow money at 3, 4, 5% as a venture capital firm, you didn't need a big return, maybe just 6%. But now, if you have to borrow money at 8% at a venture capital firm, that means you need to see at least a 10% return on your money. That means you're going to be a pickier investor, and you're not just going to keep throwing your money into the same startups that you were before, because you're going to need a more proven process and you're going to need more proven systems. So now, as a tide is starting to go out, we're going to see which companies can continue to survive, because it's going to be harder for some companies to access capital. And if it's harder for these companies to keep accessing cash and you're not producing a profit, well, then either you're going to get bought out or you're going to go bankrupt. Ray Dalio, the billionaire investor, talked about this in 2020 because he was talking about how cheap debt cannot build real wealth. Because the whole idea was, if we just cut interest rates and we allow this type of cheap investment into companies, we'll be able to produce more wealth. But he said is you can't do that. You have to create real innovation if you want real wealth. Because now what's happening is companies had no incentive to produce a profit. So companies were spending more money on growth instead of actually producing something of value. Because if I can sell you $1 for 95 cents, guess what? I'm going to get a lot of users. I'm going to get a lot of customers, because who's not going to want $1 for 95 cents? Everybody would take that deal. So it's very easy to grow, but it doesn't matter what my product is. And now, as it becomes more and more expensive to borrow this money, you're not going to see those same type of deals. You're not going to see those same type of offers, which means that certain companies may go under. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for a daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.